Okay, in this video, we're continuing our discussion of AUC Section 315 for understanding the entity and assessing the risk of material misstatement. And so in past few videos, we've been going through this particular section for understanding the entity and its environment. And that would involve understanding the industry, the nature of the entity, the application of accounting policies, the entity's objectives and strategies, and the measurement and review of financial statements. So in the first couple of videos, we discussed the industry and the nature of the entity. So for this particular video, we will look at item C, which is we need to gain an understanding of the entity selection and application of accounting policies, including the reasons for changes thereto. And they also make note that we should evaluate whether their accounting policies are appropriate for its business and consistent with the applicable financial reporting framework and accounting policies used in the relevant industry. Now, as part of the terms of engagement section, I think AUC section 210, the entity could have one of a number of different financial reporting frameworks with which we need to audit to make sure that they are within that framework. So they could be on a cash basis or a regulatory basis, international standards. So what this section is telling us is that we need to understand what framework that we are using in the audit, and that way we will know what we need to audit, and whether the entity's accounting practices are appropriate for that type of framework. Also, certain industries will have specific accounting requirements that we want to make sure that they're following when we're performing the audit. So we can go into detail about all of this later in the video, but for now, let's go down to explanatory material section A35. So fortunately, here in section A35 in the explanatory material, they give us sort of a checklist of what we might do when we are gaining an understanding of their accounting policies. So we might first look at the methods that they use to account for significant and unusual transactions. We might look at significant accounting policies in controversial or emerging areas for which there might be a lack of authoritative guidance or consensus. So these might be newer accounting pronouncements, for instance, around the time of this video, perhaps ASC 606 or the new standard regarding leases. Also, any significant changes in their accounting policies and disclosures and the reasons for those changes. So this would be good if we're performing a continuing engagement. So perhaps we audited them last year, and so now so we know what their policies were in last year's audit, and so maybe this year we just need to know what's changed since then. And next, any financial reporting standards, laws, or regulations that are new to the entity, and when they plan to adopt them. So this would tell us, we mentioned a second ago ASC 606. So if this is new for the entity, there might be a risk that they haven't implemented those procedures or those policies, or that they have implemented them incorrectly. So this will have to factor into our risk assessment. And that's why we are gaining an understanding of this. And next, we would look at the financial reporting competencies of the personnel involved and the significant new or complex accounting standards. So if we know that the personnel is perhaps maybe the CFO or the controller has taken a lot of CPE, is smart, has been involved with the company for a long time, and we know that they typically implement new standards appropriately and accurately, then we might we'll say that the risk that they're incorrect with the new policies would be low. Otherwise, if they don't have competent individuals who are in these positions, then we might have a higher risk and maybe have to perform more procedures in the area of the new accounting pronouncements to make sure that they're doing it accurately.